Very warm welcome to one and all to this week's episode of the weekly market review. My name is Benjamin Goh, the head of research and investor education here at SIAS. With us is our senior technical analyst, Sunny. So we'll be going through a couple of points today just to keep you updated on what's been happening in the capital markets. The disclaimer obviously is that SIAS is a registered charity. We're not licensed by MAS. So whatever that we talk about today, especially for specific stocks or companies, cannot be misconstrued as a recommendation. Do see a licensed financial professional before taking any kind of action in the capital markets. A couple of bulletins before we get going. The upcoming, or rather the next SIAS session for SIAS members is scheduled for the 17th of May. This is a Wednesday, 7 p.m. So in order to choke your seat, inverted commas, you can just scan the QR code over here. And the next one is if you're not yet a SIAS member, then you might want to consider signing up. So this is $1 per month for a grand total of $12 per year, which is probably less than a Grab, ride from Marine Parade to Orchard Road. So if you sign up, then of course you can join our SIAS session and listen to the jokes that I and Sunny come up with. All right, now let's talk about the earnings season. Earnings season in the US for the first quarter of 2023 is very much underway. 87 out of the 500 constituent stocks of the S&P 500 have already reported earnings. This is a small sliver, so it's only about 17.4%. But out of the 17.4% of constituents that reported, 77% actually reported better than expected earnings. So the headline analysis is that the mega banks such as JP Morgan, Wells Fargo, so on and so forth, Citigroup, have had great results. The smaller banks or the regional lenders, kind of a mixed bag, but not as bad as feared. So the credit event or the stampede of outflow of deposits from smaller banks have not really sunk them, but a bit of a mixed bag. So some are doing better, some are doing worse, but it is not a meltdown. Okay, the technology sector is frankly quite disastrous, but we've kind of expected that. So you've got a lot of headline news coming out, given what's been happening in the changes in consumer taste, as well as you can see, most of the companies, or rather the big ones, have announced job cuts. Now, even if we don't look at Meta, Amazon, or Google, so on and so forth, there are a lot of tech startups in the US that have already announced a lot of job cuts. We don't really see that because they are not really big names, but there are some public websites out there which you can go and Google and find out who has been hiring and who has been firing. This is more or less the main source of information for people in the technology sector, so you can go and Google it if you want. But as you can see, the list is quite long. And it's not just confined to the big tech companies. So technology is disastrous. We'll talk about it in a minute. Now, the consumer discretionary as well as material sector is great thus far, but there's a caveat which we're going to be looking into as well. So consumer discretionary will be companies that make things that we don't really need, like Croc sandals, Haagen-Dazs ice cream, so on and so forth. Materials, of course, is a sector that makes the raw inputs for finished goods. So you're gonna, buy a table or a sofa, you need wood, right? So wood is materials. For example, also industrial chemicals, that's also materials, so on and so forth. So that sector has got positive earnings surprise. This is basically an aggregate of the results for first quarter 2023. It's only for the 87 companies that have already reported numbers. The histogram here, as you can see, the orange color bar is basically the percentage of companies that have beaten their expectations. Okay, so we're not talking about absolute numbers. We're talking about whether or not it beats expectations. And expectations are basically guided by the research analysts. So as you can see, the orange color bar has been coming down since the second quarter of 2021. more or less. But the first quarter of 2023, that means this quarter's results, as you can see, there is a dramatic reversal in the the size of or the percentage of the companies beating their expectations. The number of, or the rather percentage of companies meeting expectations is a bit smaller, but that's also because of the increase in the number of companies meeting expectations. So that's all and good, but again, we are talking about slightly less than 15% of companies reporting their numbers. Now, this one is a bit interesting. So we did a deep dive into the different sectors, and that's how we have come up with the analysis in the previous slide. You have got the sales surprise and the earnings surprise. So let me just unpack this for you. Sales surprise basically compares the actual reported revenue versus the expected numbers. So anything which is a positive green color here means that the actual reported revenue is better than the expected revenue. On the right-hand column, you've got the earnings surprise. So similarly, this is the net profit. So if the actual net profit is greater than the expected net profit, then obviously you have got a green color percentage there. Now, straight away, as you can see, the earnings surprise column or the percentages higher, in some cases much higher compared to the sales surprise numbers. This is as per expected, simply because earnings tend to outperform sales for a very simple reason. It is hard to boost sales, or rather, let me rephrase that. If you want to boost sales, you have to sell more stuff, right? So if you want to double your sales revenue, you need to ship 2 times the number of whatever you're selling. So it's pretty straightforward. Okay, it's hard to manipulate. I shouldn't use the word manipulate, but it's hard to dress up sales using accounting tricks, because you just have to sell more stuff. But earnings is a bit different, because the net profit number that you see in a company's reported income statement is subject to accounting rules. Now, there is some flexibility on how you want to report earnings. So, for example, a one-time divestment gain because you sold a piece of property, that will show up as an income, right? It's a one-time thing, right? So reported earnings, sometimes you can't just take it at face value. You need to kind of exclude all the one-time stuff. But under this earnings surprise, this is based on reported numbers. So there's no deep dive into it. So just take it with a grain of salt. So, but in general, if you do see a big delta, a big difference in the percentages between sales surprise as well as earnings surprise, that might suggest one or two things, or maybe 2 or 2 things. One is that, well, the company is either doing something, better or something worse in terms of business model, in terms of running the company. That's why you've got a bifurcation here. Or it generally means that there's going to be a margins expansion or margins compression. So as you can see, the earnings surprise, let's take, for example, materials, right? So the materials have got a sales surprise of a negative 0.32%. That means it did not beat expectations because it's underwater, minus 0.32%. But on the earnings surprise side, you actually beat expectations by 12.85%. So that gives the impression that, well, the people in the material sector, the 4 companies that have already reported numbers, seem to be doing a good job. They seem to be squeezing out margins, although the revenue didn't move that much. So is that true? Is that not true? Okay. Now, let's put this in perspective here. Let's see, let's think about, okay, let's look at the consumer discretionary. So consumer discretionary sales surprise stands at 4.09%, while earnings surprise stands at almost 20%. So it gives the impression that, companies like Crocs and Haagen-Dazs and whatever, they seem to be doing quite well, and they seem to be doing a good job. But is that actually true? Now, if I were to compare over here, if I were to compare the surprise column versus the actual growth column, then that will give a fuller picture. So the panel at the top is the same as the previous slide. The panel below is actually the growth numbers. Now let's take a look at the materials again. So previously we had an earnings surprise of 12.85%. But here it says that for the four companies, in aggregate, the earnings growth was a whopping negative 42.63%. So what does that mean? It means that the earnings growth, not earnings as an absolute number, but earnings growth actually almost halved, right? Then how come the earnings surprise is still plus 12.85%? Well, that's because the analysts actually expected worse off numbers, right? So the actual earnings was not as bad as feared. That's why you have got a positive earnings surprise, while the actual earnings growth was way, way underwater. Now, this gives a lot more perspective to the previous panel. Again, you look at technology, right? So technology earnings surprise was a negative 11.85%, but the earnings growth was actually negative 36.86%. So as you can see, the analysts actually had very, very bad expectations for earnings growth, and the actual numbers came in not as bad as feared. So that's why, or rather even worse than feared, because it's negative 11.85%. So that means technology is really, really badly hit, right? Now, so the impression given here is that if you look at these two panels side by side, or top and bottom, the narrative is that perhaps on an aggregate level, the fundamental analysts, the ones that write all the sector reports as well as the stock reports, maybe they were a bit too bearish, as in they thought that it was going to be really, really bad, and the actual numbers that have come in are not so bad. Now, also take that with a grain of salt, because as we have discussed just now, earnings is also subject to accounting treatment, right? So there are certain ways you can get, certain things you can do accounting wise, 100% totally legal. That means yes, allowed, that you can use to boost up your earnings. That's why it's always also very important to look at both sales as well as earnings. So you've got a top line, which is revenue, and the bottom line, which is net profit. So usually you need to have both directionally correct. So obviously if revenue drops while earnings is a huge positive, then of course, there's something wrong with the narrative. Okay. All right. So things are not as bad as we feared. Now, moving on, let's look at something else. Now, the stock market has not really fallen off yet. So the expectation was that there was going to be another perhaps 10% drop heading into the second half. Of course, we are still early. This is only the third week or the final week of April. So we've got another week to go plus May. And then June, the second quarter before we head into the second half. But it looks as though the earnings recession is coming to an end. And before we discuss further, the earnings recession is defined as 2 consecutive quarters of profits below their 1 year earlier level. That means year on year earnings net profit is negative. So you've got 2 quarters of negative year-on-year earnings growth. Then that is defined as an earnings recession. Well, the news is that the earnings recession has been in place since June 2022. That means the second half of 2022. So as you can see, the numbers, this is again on the aggregate level for the S&P 500, right? The trough actually came in March. Or rather March is now, second quarter 2020, or rather first quarter 2023. That is forecasted to actually decline. So as you can see, underwater over there, the yellow section, by June 2023, it shouldn't be as bad. And then going forward in third quarter onwards, it should be a positive earnings growth. All right. So one hypothesis for the, in a way, irrational exuberance in the stock market is that, people are betting that the earnings, corporate earnings of companies are going to be, in positive territory in the second half. And you have the FOMO, fear of missing out. So people are jumping in. There is a piece of anecdotal evidence that's coming in the last few weeks. There's been an inflow, a huge inflow of money moving into equity ETFs. And of course, we are all scratching our head. So I thought the recession is on, right? Well, anyway, so perhaps the main street is having more common sense compared to Wall Street these days, okay. But the earnings recession is forecasted to come to an end in the months going forward. Now, the one other thing I want to talk about is operating margins. So earnings is basically the bottom line. Bottom line will one of the key drivers of the bottom line as a net profit is, of course, operating margin. All right. So operating margin is basically your revenue, your sales minus your cost of goods. That means the cost of actually making the product. That's your operating margin. You have got three lines here. Again, this is on aggregate level. You have got the blue color line, which is your CPI, the Consumer Price Index. This is basically, again, this is for the US, yeah. The blue color line is the CPI, Consumer Price Index. The white color line is the CPI, excluding food and energy, okay? And the orange color line is the PPI, the Purchasing Price Index. Now, the Purchasing Price Index is basically the aggregate price levels or aggregate prices that manufacturers need to pay whenever they want to buy things like energy, rubber, plastic, what have you. All right, so manufacturers need to buy all these things, put inside the factory, make products. So obviously the delta, the difference between CPI, as in what retail or what consumers actually pay, versus a PPI, which is what the producers actually pay. This part here, quite loosely, that will equal operating margin, right? Okay, so not 100% linear, not totally true, but more roughly the principle is there. So as you can see, the orange color line is the PPI is so far below the blue color line, which is CPI, and again, so far below the white color line, which is the CPI minus food and energy prices. Now, again, as you can see, this chart here is normalized for the beginning of 2022. Okay, so I wanted to show the rate of change, not the actual differences in the percentages. But as you can see, the PPI is falling so much faster compared to the actual CPI, whether or not it includes food and energy. So the delta is increasing over time. That suggests that the operating margins of companies are improving as well. So this actually supports the previous slide that shows the earnings recession coming to an end. All right, so again, the timeline that we have articulated in the beginning of the year is still there. The first half is going to be a bloodbath. The second half is where things will improve. Sunny is going to be talking about Fed policy as well as perhaps the terminal interest rate coming up in May. So I'll get to him. But the narrative that we have communicated at the beginning of the year is still intact. The second half should be the turning point of capital markets. All right, Sunny, over to you.
Hey, thanks, Ben, for the insightful sharing. So I'm going to share my screen first. So key takeaways I heard from Ben sharing just now was that 87 companies of the S&P 500 has reported and 77% managed to beat their expectations. But this 77% numbers that beat expectations did not really sort of push the index higher or pull up the market by a lot. Later on, we will touch on the technical indication in the charts. Later on, you will see why. So for now, I think the expectations set by analysts is actually quite low because of the macroeconomic environment, the fear of recession, as well as the Fed increasing interest rate further in the next few months. So let's take a look at the target rate probabilities of the Fed Fund futures. So this week, we are still seeing the same probability as per last week or so. So this week, the probability is like 89% that we are likely to see another 25 basis point hike to bring the interest rate from the 5% to the 5.25%. And this is an increase from about 1 week ago at 77.97%. So as we get closer to the May meeting date of 3rd of May, we are going to see that market is going to price in a 90% chance now that we are likely going to see a 25 basis point hike again in May, which is just a few weeks away. So economic calendar this week, of course, we have the GDP quarter-on-quarter numbers coming out. So this is a number where we want to watch to see if we are going into a deep recession or just a very mild touch and go kind of recession. The previous reading was positive 2.6 And then the consensus now that we have is 2%, so a drop of about 0.6%. So we are trying to stay around this consensus number to say that we are not really going into a very bad recession. And then we have the core PCE price index data coming out on Friday. So the previous reading was 0.3. We are expecting the number to stay around the same, thereby sort of easing the fears of the inflation being run away, so that we are still seeing that inflation is being controlled at the consumer price index level, core PCE price index level, which is one of the indicators that the Fed watched very closely. And of course, next week we have the ISM PMI data, manufacturing PMI data, which previous reading coming in at 46.3, which is below the 50-point mark, so it is still a contraction. On the earnings side, this week, as mentioned by Ben, we are going to see mega blockbuster earnings from Microsoft as well as Alphabet. Later in the week, we are also going to see Facebook. We are also going to see Amazon. So this is going to be a blockbuster week for the tech earnings companies. So next, I'll move to the technical side of things. Let's look at the charts. So for the Dow Jones Index, as you can see over here in the past week, it has been quite muted. In fact, for the past 1 week, the Dow Jones Index is down 0.51%. But for the past 1 month, since the low in March here, you can see that we are up about 3.8%. Year to date, since January to what we see today, we are up about 1.99%. So this is the reason why I say, although we only have 87, a very small fraction of the S&P 500 companies reporting, it has not give the indices, whether it's Dow Jones, S&P 500, or even the Nasdaq Composite, any boost in the index movement. So this means that after the earnings season is over, if the earnings, most of the earnings did not manage to beat the expectations, then likely we would have lost another catalyst to bring the index higher. Thereby, there might be some kind of a pullback on the major indices. So key levels to watch for the Dow Jones Index includes this January to February double top formation that you see around the 34,281 point level, as well as a red color downwards trend line, which is connecting the peak in January of last year, as well as the peak in December. Thereby, this is a long-term downwards trend line that a lot of investors are watching as well. Hence, you can see that in the past few weeks, or in the at least last week, when we start to challenge this downward trend line in red, we are seeing that any upside is being kept below this downward trend line. On the support side, key levels to watch, of course, would be the year-to-date low, which happens in March around the 31,429 points level. And if we connect the low of October last year as well as the March low this year, we have a upwards trend line, which is highlighted here in green. So that would provide the support for Dow Jones Index in case there's a pullback that's going to happen. So this upward trend line also found some confluence with the lower bound of the Bollinger Band at 32,297. So this would likely provide a good support for the Dow Jones Index going forward. So if we look at the indicator side for the Dow Jones Index, the MACD indicator, as you can see, if we look at the MACD histogram for the past 2 weeks, it has been losing momentum. So you can see that the MACD histogram is fading away in the background. As well, you can see the MACD line converging towards the signal line. Now, if the MACD line cross over the signal line, that would mean that we are going to see a bearish reversal happen. And I think that's going to happen very soon in the next couple of weeks. So if that's going to happen and the MACD line cross below the signal line, be prepared for a bearish reversal downwards to the support level, at least to the low bound of the Bollinger Band. And if the MACD line and the line both cross below the zero baseline, then the downward swing would likely be more heavy, more aggressive, like what we observed here in February, where both the MACD and the line cross below the zero baseline, and we push the index up from the higher to date high all the way down about 8% to the March low this year. So this is a scenario that might happen depending on how the MACD indicator is going to turn out. So do keep a close watch on that. The RSI reading at 60.07 last Friday close is showing still pretty healthy momentum. It's 10 points above the 50-point neutral mark. It's 10 points away from the 70-point overbought signal. So it is still healthy at this range reading. But then if you look at the trend of the RSI, since the low that we see in March here, where we see an uptrend happening towards the end of March, as well as slightly a bit of early April, this uptrend that you see in the RSI indicator has also been subsiding, has also have a pullback of a little bit, although we did not sort of cross over the 70-point overbought mark, I can see that the RSI is starting to lose its momentum as well. So that is also another indication that the uptrend that we see since the low of March might not sustain going forward into the next few months. Okay, that's my take on the Dow Jones Index. Next, let's move to the S&P 500. For the S&P 500, it was pretty flat for the week, I would say. For the past 1 week, it's down just 0.16%. For the past 1 month, since the low in March here, we are up about 3.29%. Year to date is the low here, the year to date low in January to what we see today is up about 7.27%. So key resistance level to watch, of course, a lot of analysts are watching this 4,200 points or the year to date high that we see in February at 4,195. So a lot of analysts are saying that if we are going to hit this 4,200 points again, it will form a double top formation, which is a very bearish formation, and then we will see a pullback on the S&P 500 index. On the support side, of course, the support we'll be looking at the year-to-date low that happened in March here at the 3,810 points level. If we connect the low of the March with the low in October last year, we have a upward sloping support trend line as well. So that would provide a support for the S&P 500 should a pullback happen. And this will be a long-term support for the S&P 500 uptrend to stay intact. It needs to stay above this support trend line, upward support trend line that we connect above the bottom in October last year as well as March this year. On the MACD indicator, similar to the Dow Jones Index, the MACD line is converging towards the signal line. The MACD histogram is indicating to us that momentum, the uptrend momentum since the low of March has been subsiding now. So a pullback is likely to happen. And if we get a retest of the 4,200, I will not be surprised. A lot of traders would have been piled in or stacked their orders above 4,002 to sell the index down. At least to the 20 days moving average, which is the Bollinger Band basis at 4,092 points, or even to the lower side, to the lower bound of the Bollinger Band at 3,974 points, which may likely have found confluence with the upper trend, the upward sloping trend line of the green line highlighted here. The RSI indicator, the latest reading 59.79, is a healthy kind of a reading. We can see that the RSI has been trending upwards since the low in March. However, for the part of April, it has been sort of plateauing and sort of a range bound moving sideways around the plus minus 60 point level. So that might mean that we are coming to the end of the uptrend momentum that we see over here in the RSI. So the indication is that RSI may have a peak also. And if the earnings season is not going to provide any kind of earning beats going forward, then we might see that the RSI start to lose momentum as well, and hence a bearish reversal might happen, pulling the index back to the lower bound of the Bollinger Band, testing the 4,000 handle again towards the 3,974 points lower bound of that Bollinger Band. Okay, next, let's move to the Nasdaq Composite Index. For the past 1 week over here, Nasdaq Composite Index is down 0.38%. For the past 1 month since the bottom in March, we are up about 1.81%. Year to date, we are up an impressive double digits, 14.30% since January. So key levels to watch for the Nasdaq Composite Index, of course, year to date high happened in January here, this red line here. The 12,269 points level would be a great resistance level to watch. You have seen that we have come in very close during the early part of April to retest this high. And recently, we also have on 18 April, trying to test that level. But for the past 2 weeks or even 3 weeks, I would say we have not touched at least the year-to-date high yet. So we have not formed any higher year-to-date numbers. So if we are going to see that happen, it will likely be a double top formation, which is a bearish formation, as I said earlier. On the support side, if we connect the low in December as well as the low in March, we have an upward trend line in green. And this will provide the support for the Nasdaq Composite Index to keep the uptrend that we see so far intact. Okay, so this level would likely be around the double top formation that you see. So this double top formation, which happened in December last year, is actually a bearish formation. As you can see, after that, the index actually went down. However, if this were to fast forward to this year, this double top may have a change in polarity. We are not sure yet, depending on the indicators reading as well later on that I will explain. So this is a key level to watch. If we breach this level, that would sort of find confluence with the upward trend line to provide support for the Nasdaq Composite Index. On the MACD side, you can see that we have actually the cross of the MACD line has actually happened below the signal line has happened last week. You can see that the histogram reading is now negative 14.63. So this means that if the MACD line were to diverge away further from the signal line, we will see further pullback of the Nasdaq Composite Index going into the next few weeks towards the end of the earnings season, which a lot of analysts have been saying that the tech company's performance has been very bad. And this week will be the mega week where you will see the earnings of Microsoft and Alphabet coming out, which would likely lead where the Nasdaq Composite is likely to move. So the RSI side at the 55-point reading is compared to the three indices, which average around 60, is on the weaker side. So we have also seen that since the peak that we see at the end of March and early April of the RSI around the 65 or 64-point level, the RSI has been slowly coming down, and now we are sort of 5 points away from the 50-point neutral mark. If we go below the 50-point, it will mean that momentum is weakening significantly, and thereby more pullback is expected towards the lower bound of the Bollinger Band at 11,762 points. So that is the three technical updates on the three US major indices. Let's move to the Asia side to look at the Hang Seng Index. So this is the Hang Seng Index. For the past 1 week, it is down about 1.75%. For the past 1 month, it's up 0.49%. Year to date since January over here is up 2.28%. So where is the HSI likely heading? I would say it's pretty unclear, but definitely we have a big resistance level here around the 22,449 level or the 22,700 level, which was the high that we saw in January this year as well as June last year. So it's a very long-term, a double top kind of formation. So it's a very, I would say, a very heavy resistance level to watch out for. However, now the HSI, we are still in the middle of that, so that will not come into play that soon. On the support side, we have the March low this year. So this is around the, let me put this in green so that it will be clearer, around the 18,829 points level. So this is the support level to watch out for the Hang Seng Index. It's also very close to the May low that we see last year at the price level of about 19,178 points. So the 19,000 handle would likely provide some support for the HSI Index going forward. As you can see over here, this looks like an inverted head and shoulder kind of formation. So this is the shoulder, this is the head, so it's an inverted head and shoulder. For inverted head and shoulder, the pattern is telling us that we might have a break higher. So the indication of the chart pattern from the HSI Index seems that it is signaling to us that the index may have a chance to move higher. However, the indicator side seems to have provide some contradicting signal. The MACD line have crossed below the signal lines, giving us a negative MACD reading. So even if you are going to play the inverted head and shoulder kind of formation, you should sort of hold your horses for now and wait for the indication to turn in your favor. So MACD histogram is starting to turn negative, so a bearish reversal might happen. And if this bearish reversal happens on top of the inverted head and shoulder, we might see a double bottom formation happening again on the Hang Seng Index, which will give you further confidence to play on the long-term trend going forward for the HSI Index. The RSI has also broke below the 50-point neutral mark at the reading of 45 right now. So that means that momentum in the Hang Seng Index is actually weak. So my preferred option for the Hang Seng Index is actually to wait for the indicators to play the full pullback all the way to the year-to-date low of March this year before considering a move back into the Hang Seng Index for the longer-term play of a long position towards the end of the year. So that's my take on the Hang Seng Index. Lastly, let's move to the STI Index. So STI Index for the past 1 week is up about 0.21%. So we are up 0.21% as compared to the other major indices. The past 1 month since the low in March, we are up 3.22%. Year to date since January, we are up 2.17%. So where is the resistance level to watch for the STI? That will be, of course, the January year-to-date high that we see here is the 34,008 points level. So 34,000 handle, great resistance for the STI Index. On the support side, we have the low that we see in December, where the index, STI Index is kept range bound during the December period. That will provide some support for the STI Index as well. Or let me change this to green color. Okay, so at the 3,225 point level, that will provide some level of support for the STI Index, which is close to the lower bound of the Bollinger Band at 32,042 points reading. Of course, further down, then we'll have to move to the year-to-date low in March, which is the 3,094 points level or 3,100 point level handle. That would be a further support for the STI index. Looking at the MACD indicator, we also see in line with what the major indices are saying, MACD line converging towards a signal line means that the uptrend that we see since the low in March is subsiding and coming to an end. The histogram in the background of the MACD is also subsiding, thereby telling us that the uptrend momentum is now becoming lesser and lesser. So that's why you see that we are capped at the 3,300 points level for the STI index, which I would say is a pivot level for now. But looking at the indicators, it might continue to be a resistance level that we see that also was being tested in the early part of January as well. The RSI reading at 58.47, that is also a healthy reading right now, which still means that it's above 50. That's uptrend, positive uptrend momentum for now. However, if it closes below the 50-point mark, we will see that a bearish reversal might happen for the STI index. So do take note of that. We are now at a pivot level of 3,300. Index could still go up or down, but then the indicators is telling us that it is likely going to move downwards further. Hence, 3,300 looks more like resistance level to me, at least for me right now. Okay, so that's my take on the weekly technical update this week. Any points to add, Benjamin?
No, looking good. So thank you very much for that. So with that, we're going to end today's call. Thank you very much for joining us today. Do take note of the upcoming SIAS session. So have a great week ahead.